Hi, I'm Steve Spencer from SMB Capital, and today I want to spend a little bit of time covering a topic that we see often on finance Twitter, on StockTwits, and really has been the single greatest trade on a percentage basis in terms of a win rate and its risk reward, probably for over 5 years now, since the market bottomed in November 2011. And obviously there's been a couple of periods of heightened volatility, but even during those periods of heightened volatility, this trade has worked quite well, and it's the buy the dip trade. And so I don't know if I've ever done a video on this before, but I wanted to very simply look at the S&P 500 via the SPY ETF and give you an example, or give you some examples of how to attack this trade based on specific buy points, and understand there is no correct way or a single way to attack this trade. I have my own personal way that I like to do it. I'm usually the first person in if I have a clear spot that I want to get involved. But I'm going to highlight for you four different spots where different traders, based on certain levels of aggressiveness or conservativeness, I don't even know if conservativeness is a word, conservative, would get involved. And so let me outline the scenario for you. So what we had was, at the beginning of March, the S&P put in an all-time high. We topped out in the first week of March around 240 on the SPYs. We'd come into the mid-230s, and then we had a Fed meeting, and that week we also had a vote on repealing Obamacare. So there were some things on Wednesday and Thursday really to drive the market, to get people to kind of jump in or jump out. And we saw a little bit of volatility, a little bit more weakness, but we kind of held in the mid-230s, and we didn't break down. But then we went into the weekend, and it seemed like over the weekend on Sunday night, some people people did push the futures down, ostensibly because now they were concerned that, hey, we can't even repeal Obamacare, which Republicans have been promising to do for years, that maybe the tax cuts won't happen, maybe there will be no infrastructure spending. And on Sunday night, where then there's not a lot of liquidity, it's a little bit easier to kind of push the market down than during the day when everybody's sitting at their turrets with billions or trillions of dollars in buying power. So Sunday night, the futures get pushed down. It's our first Sunday night future gap down in quite some time. A little bit of excitement on Twitter on Sunday night. A few people tweeting it out right away when the futures opened. And coming in Monday morning, our plan, what we discussed in our morning meeting in the pre-market that we do every day, was, hey, we're going to buy this dip. And we had a bunch of different reasons why, which I don't need to go into now. And we kind of outlined where we wanted to get involved and what we needed to see. As traders, we come in with a plan, and we have an area where we want to get involved, and then we talk about, once we get involved, what do we want to see to confirm that our trade is working? Because when trades aren't working, that's when we want to get the hell out. So if we look at this chart here, I give 4 potential buy points, and the first one is really a flush below 232, kind of near the overnight lows, the pre-market lows, where I'm going to get in, not necessarily all in, but I'm going to get in there, and then I want to see if other buyers are willing to step in. These are the most aggressive people. For me, I'm comfortable jumping in there because this is not the first move off of the high in the market. Market topped out at 240. We came off $4 or $5 into the mid-230s. SPYs came down another $1 on a dividend paid a couple of weeks ago. And so this gap down of $2 from the Friday's close, this is a really nice buying opportunity. And so number one, that's the point where I'm getting involved in the pre-market. The next thing I want to do, and the aggressive traders, but a little bit more conservative traders, they're looking at point number 2. They want to see if the market can actually get above Friday's low. And that's point number 2. We got that. Friday's low was taken out, and then we got back above it. We held, and that's another spot for people to look at to get involved. We look at the next day. Point number 3 is, does that level hold? Do we get a higher low in the market? That's another spot. The next morning, you can see we ticked down a little bit. We came into that support from Friday, and it held. And then a lot of people jumped in, and then you can kind of see, green bar, green bar, green bar, green bar, as people start to chase that move up. And then finally, the last spot is when we just got above 235, it had been the high of the prior day. Can we hold above there? We did. Those are the different spots, and it's again, most aggressive to least aggressive, most conservative as buyers are stepping higher and higher. And as the traders are a little bit more timid or investors are a little bit more timid jump in, it creates the potential for a V bottom. We can take a zoomed in look at this. If we look, on day one, and also I want to just make this point. For short-term momentum traders who have the skill of reading the tape, and this is something we teach on our desk. This is something we have a program for called Reading the Tape that we offer outside of SMB through our education arm as well. What I'm doing there, right on the open, you can see that circled area, is I'm looking to see if there are buyers in that area at that's kind of that 60-cent level. And what you can see is that first little area that I've circled, every time the market came down, put in a low right on the open, it would come down and then it would close higher. It would come down and close higher. So what I was seeing there right on the open on the tape was buyers were willing to step in that area, what was I think 231.60, 231.65. Once I saw that on the open, the buyers there, I just put in some more bids at those levels. It was simple 15 cents of risk. And if we reverse, I know on a gap down, if we fill that gap, we're looking at $2 of upside for 15 cents of risk. I don't know if it's going to work out at that point, but when it does, that's the 10 to 1 plus risk. And it's also from a swing perspective, if you're a swing trader and you're watching this video right now, this is a way to increase the risk reward on your swing trades. Most of the swing traders I know, they're putting on risk reward 3 to 2, 2 to 1. If you understand these entry points and you learn how to read the tape, all of a sudden on your swing trades, you're increasing your odds to 5 to 1, 10 to 1, etc. And then the second point on that zoomed in chart, what you can see is the area that I've circled is the spot. Once we've had that first up move, can we get the market to hold higher and consolidate in a sideways fashion? We got that. So again, this is the more aggressive traders as well, but between 10 and 11 o'clock, it's holding higher. And that's another spot for you to get in.